Hello everyone. Today we are going to start a new chapter on open economy models. Just like when we talk about closed economy models, we will start with an open economy model without money and then introduce money into the open economy. This big picture shows you where we are in the macroeconomic theory. In the first semester, we focus on the RBC model, the real business cycle model, in the static and dynamic dimensions. And then we introduce money into the RBC model in the second semester. We also discuss two types of monetary models without nominal frictions and with nominal frictions. This chapter, on the other hand, will extend our RBC model to include the rest of the world, so that we have an open economy model. Macroeconomics related to open economy is usually called international economics. If these international economic models do not have any money in it, then it is usually called international trade theory. And if you introduce money into it, it's called international finance theory. We will start with open economy without money, so basically the international trade theories. In this lecture, we have 4 learning objectives. The first one is to understand why international trade becomes more and more important. The second learning objective is to know what is small open economy assumption and why it is used for our models. The third one is to know how to model a small open economy with credit and derive how current account CA is determined. And finally, we would like to take into account the default risk in sovereign debt and discuss how to reduce this default risk. Before this lecture, we have already seen how to model a closed economy with and without money. But for many interesting macroeconomic problems nowadays, we must do our analysis in an open economy context. Therefore, the logical typology of the open economy models are similar to that of closed economy models. As we mentioned earlier, the literature on open economy issues is called international economics, which includes international trade, which is usually a real model, and international finance, which is usually a monetary model. This lecture will focus on the real model or open economy models without money. We will introduce money into the small open economy later, which will be further divided into models with flexible prices and wages and models with sticky prices and wages, just like what we have discussed in the closed economy models. To answer the first learning objective, we will briefly introduce the history of international trade. There are basically 2 waves of globalization in human history. The first wave is before the 20th century. The main form of globalization, wave 1, is colonization and force. The United Kingdom was once the biggest colonizer, but this attempt finally failed due to World War I and World War II, followed by a number of independence of colonies from their colonizers, such as India. The second wave of globalization, wave 2, starts after the Second World War. The main form of globalization 2 is international trade. It is still ongoing. But there are 2 barriers to this process. The first one is the natural barrier due to the transportation costs. Development of transportation technologies and information technologies have reduced that natural barrier significantly. In contrast, artificial barrier is much more difficult to reduce. But the trend is that tariffs are reduced and quota are removed through global trade agreement like GATT, the General Agreement of Trade Tariffs, which is later replaced by the World Trade Organization, the WTO. There are also some regional trade agreements like the EU and NAFTA. However, the rise of protectionism since 2016 resulted in some regressions of this trend, like the Brexit and Trumpism. Note that trades of goods are always accompanied by trade of capital, so the world financial markets are developed at the same time to facilitate the trade, including the forex market, credit market, and FDI, the foreign direct investment. In this chapter, we will focus on a dynamic small open economy models, or SOE models, which assumes that the domestic economy is very, very small, so it has no effect on the world prices. They're all price takers, just like any individuals in the competitive market. And since it is dynamic, so we will have credit market, like the RBC model with dynamic settings. The small open economy model with credit in this chapter is actually a very simple extension of the chapter 9 dynamic model with two periods. In fact, the analysis of this SOE model is even simpler than the dynamic model because of the extra assumption of SOE. Now let's summarize all the assumptions of this SOE model with credit. First of all, consumers maximize their utility under their budget constraints. But just like in the dynamic model in chapter 9, they are allowed to borrow from the rest of the world or lend to the rest of the world. The net lending is denoted by SP. So if SP is negative, that means they are net borrower, and if it is positive, then they are net lender. Second, the firms are assumed a way to simplify the analysis. In the more complete model, there will be some firms producing the output, but in this model, we will keep it simple, so there is no production. The output in this period and in the future periods are denoted by Y and Y prime. They are exogenously given. 3. The governments simply keep their ends meet, but they can raise public debts and a lump sum tax to fund the government expenditure. The gap between the expenditure G and the tax revenue T is denoted as minus SG. The minus SG is the public debt or deficit of the government. 4. Since we assume a small open economy, the domestic interest rate R is equal to the world interest rate. The domestic economy cannot do anything about it. They are price takers, so R is exogenously given. Mathematically speaking, all the economic behavior of these individuals will have to follow some optimization rule. After taking the derivative, we can solve the system of equations to obtain the solution of the endogenous variables in terms of the exogenous variables, but because it is too complicated, so this module does not require you to be able to solve the system mathematically. Instead, we are going to use graphs and intuitions to explain the effects of exogenous variables on the endogenous variables of this small open economy model. Nevertheless, the maths and the graphs are actually telling the same story from two equivalent perspectives. To make our graphical analysis more based, we will have to talk about some maths. Firstly, the consumer's lifetime budget constraint can be written in this way by combining the two periods' budget constraints. The left-hand side is basically the present value of consumptions, and the right-hand side is the present value of the disposable income. This is exactly the same as the Chapter 9 dynamic model. Secondly, the government lifetime budget constraint can also be written in a similar way. The left-hand side is the present value of government expenditure, and the right-hand side is the present value of tax revenue. There are also changes on the market clearing conditions after we introduce the small open economy assumption. For example, in the output market, the aggregate demand of output can now be decomposed into C plus I plus G plus net export. In this simple model, the net export is basically the current account, and we assumed away the firm's production function, so I can be ignored here. In the credit market, the current account has to be cleared by the savings in the private sector and the public sector, SP plus SG. The intuition behind this identity is the balance of payment. That is, if you import more than you export, then you will have to borrow the money from the foreigners so that you can finance this gap. And reversely, if you export more than you import, then you will have to save the extra amount of your export or net export or current account in some way so that you don't waste the interest of your lendings or savings. In practice and in general, the current account should include more than just trade balance, which is the biggest component of current account. But current account CA also includes the net factor income, which is the interest payments on foreign assets or debts. And it also includes the international transfers, such as financial aid and charity donations. Then we can combine the consumers and the government's budget constraints to have a consolidated country's budget constraints. The left-hand side is the present value of the consumptions from the consumer and the governments, and the right-hand side is the present value of the endowment of the economy. If we further assume that the private goods of consumers C and the public goods of the governments G are perfect substitutes, then consumers' choice is essentially to decide the optimal bundle between today and tomorrow's consumption, C plus G and C prime plus G prime. If we draw this combined national present value budget constraint, we can use a trick similar to the individual budget constraints. That is, we can choose two special points on this budget line and then link the 2 points, because any 2 points can fix you a line. The first special point is when the future consumption is equal to 0, that is C prime plus G prime is equal to 0. In this extreme case, the general budget constraints becomes C plus G equals to Y plus Y prime divided by 1 plus R. That is, all you consume today is equal to the present value of the endowment. Reversely, the second special point on this combined national present value budget constraint is that when C plus G is equal to 0, then the future consumption C prime plus G prime is equal to Y multiplied by 1 plus R plus Y prime. And that is to say, if you consume nothing today, then tomorrow you will consume the future value of your endowment. If a specific utility function for the consumer is given to you, you will be able to solve the optimal choice for this consumer or for this nation, basically, by taking partial derivatives with respect to the endogenous variables C and G. The resulting optimality condition is actually the intertemporal conditions of the dynamic model. We can then solve the endogenous variables in terms of the exogenous variables like the interest rate. But fortunately, in this semester, you are not required to do it mathematically. Instead, we are going to use the three-step approach introduced in the previous part to graphically derive the effect of exogenous variables on the endogenous variables in this small open economy model. The graph on the right shows you how it graphically determines the optimal choice for a country that is a lender in the current period. As discussed in the previous slide, to draw the combined budget constraint, we will need to choose the two special points to fix this line. Point A is when all the endowment are consumed today, and point B is a special case when all the endowment are consumed in the future period, and point E is the endowment point if you do not borrow or lend, and point D is the optimal choice for this country if it can lend and save in the international credit market. For different calibrated utility function, obviously you will have different points of D, but in this case, our point D lies to the left of the endowment points of the current period. That means you will consume less than your endowment today. So you will save some of your current period's endowment for the future period consumption. But obviously, the opposite is also possible. If point D lies to the right of point E, then you will consume more than you are endowed, so you will be a net borrower. So the current account of a small open economy is the counterpart of the savings of a closed economy model. But this savings now is national savings rather than individual savings. To see this, you can rewrite the output market clearing condition. So CA is expressed in terms of Y minus C minus T. And in the closed economy model, the savings is defined as output minus consumption minus T. So savings is basically the current account in the open economy. To summarize the small open economy model with credit, we can divide the model into two types of variables. The endogenous variables include like consumption today and tomorrow, taxation today and tomorrow, and current account. And the current account can be interpreted as national savings. The exogenous variables include the output endowment Y and Y prime, the government expenditure G and G prime, as well as the interest rate, which is taken as given. We can also derive graphically the following conclusions. The first one is the current account or national savings will rise with the increase in the current output. The intuition behind this conclusion is that if you are richer today, you would like to smooth your consumption by lending the current extra output to the foreigners so that you can consume more tomorrow rather than consume everything today and consume less tomorrow. The second conclusion is that the current account or national savings will fall with the increase in the future's output. The intuition behind this conclusion is that if you expect to earn a lot tomorrow, then you will borrow some of the money from yourself in the future so that you can smooth your consumption over the period, rather than consume a lot in the future but be starving today. The third conclusion is that current account is independent of changes in the timing of taxation. This is actually the regarding equivalence theorem we have derived in the dynamic model in the previous semester. Conclusion 4 and 5 are about the effects of the interest rate on the current account. But there are two possibilities, so that is why we have two possible effects. If current account is negative, which means you are a net borrower in the current period, then an increase in interest rate R will increase the current account. This is also straightforward because if interest rate rises as a borrower, it means the cost of financing increases, then you will borrow less or save more, which means an increase in current account. While if the current account is positive, which means you're a lender in the current period, then an increase in interest rate has an ambiguous effect, because the substitution effect SE and the income effect IE have opposite directions. The key to understanding all these conclusions is to treat a country as an individual, so the current account can be treated as a national savings to smooth the consumption over the periods. Well, if the current account plays a similar role of savings, then the current account should be positively correlated with GDP to reflect the consumption smoothing. However, as you can see from the data on the left, the current account and GDP are obviously negatively correlated. So how can we explain the discrepancy between the theoretical prediction and the empirical observation? One possible reason is that due to the globalization, the business cycles of different countries are actually highly synchronized. So when the US is in the recession, the UK tends to be in the recession as well. It's like if you are poor now, you need money, and you go to your neighbors to borrow money, but your neighbor is even poorer. So you end up with lending money to him rather than borrowing money from him. Now let's talk about a simple extension of the small open economy model with credit. Let's denote B as the balance of national indebtedness in terms of future value. The national indebtedness consists of both private and public debt. Like private debts, default risk also exists in the public debt. Let's assume there is an initial debt, B, to be repaid in the current period for a country. Note that in the previous baseline small open economy model, this B is equal to 0. In the case where B is positive, the national budget constraints are rewritten in the following way. The current period budget constraint has an extra minus B term on the right-hand side. The future period budget constraint doesn't change, but the current account definition also has to take into account of this extra minus B in the current period. If we combine these two periods budget constraints to an intertemporal budget constraints by substituting out B prime, then if there is no default, the intertemporal budget constraint can be rewritten in this way. Note the extra minus B term on the right-hand side as an extra outflow. Now assume that this country can now default in the current period at the cost of V, capturing the loss of the country because it will suffer from being denied access to credit market in the future. To default or not to default, that is the question. So let's compare these two cases. If it chooses to default, then the right-hand side will have to take into account this present value of V. If it doesn't default, then the right-hand side will have to put this minus B as an extra outflow. The answer to this default decision is simple this way. If the present value of the default cost is less than B, then you should default. Otherwise, you should not default. We can use this theory to explain how to prevent the Greece during the global financial crisis to default. You can click here for further discussion. But basically, there are three ways of doing it. The first one is to raise the cost of default. And the second is to reduce B. While there is a third choice, you can simply leave the Eurozone and go back to your own currency so that the central bank of Greece can issue any money to pay back its public debts. To summarize, this lecture introduced the dynamic model with credit market in a small open economy setting. And please do remember the key to understanding all the conclusions and implications in this chapter. That is, treat a country as an individual and treat the current account as the national savings, and everything else will be straightforward. Read chapter 16 of Williamson and do the self-test. Have fun!